What if the most powerful chain in the world isn't made of iron, but of promises? What if decisions made decades ago are quietly binding people who don't even exist yet? Here's the mystery. Every year, governments sign financial agreements that outlive elections, leaders, and entire generations. Babies are born owing money. Futures are pre-decided by numbers written long before names are chosen. Yet almost no one talks about it. We're told it's normal, necessary, responsible. But if this system is so beneficial, why does it require silence? Why do the same institutions grow stronger, while citizens inherit more obligations? Tonight we're uncovering the invisible chain linking governments, banks, and generations not yet born, and why once you see it, you can't stop seeing it everywhere. Setting the stage, promises that outlive people. To understand this chain, we have to start with a simple idea, a promise across time. When a government borrows money, it isn't just making a financial decision. It's making a promise that future taxpayers will honor that debt, even if they never voted for it, even if they never benefited from it. This idea didn't begin in modern times. In medieval Europe, kings borrowed from merchant banks to fund wars. When kings died, the debt didn't. It transferred to the crown, then to the people. This was one of the earliest moments where private finance began shaping public destiny. Over time, that relationship formalized. Central banks emerged. Government bonds became safe assets. Entire financial systems were built around lending to states. Here's the twist. Once debt became institutional, it became permanent. Governments stopped borrowing for emergencies and started borrowing to function. That's when the chain became invisible. Origins. How future labor became collateral. The real origin of the invisible chain isn't money, it's time. When governments issue debt, they're not pledging gold or land. They're pledging future labor. Taxes that haven't been collected yet. Productivity that hasn't been created yet. People who haven't been born yet. This concept exploded with the rise of modern banking. Banks realized governments were the ideal borrowers. They don't disappear. They can tax. They can print money. Default is politically unthinkable. So lending to governments became safer than lending to businesses or individuals. At first, this seemed like a win-win. Governments got funding, banks got stability, citizens got infrastructure. But slowly, something changed. Debt stopped funding the future and started consuming it. The rise. When debt became the system in the 20th century, especially after major wars, government debt exploded. Wars were too expensive to fund through taxes alone. Borrowing became the solution. Bonds were sold to citizens, institutions, and foreign governments. After World War II, this system didn't unwind. It expanded. Governments discovered they could stimulate economies through deficit spending. Central banks could manage interest rates. Growth could be engineered. But here's the cause and effect few noticed at the time. Every economic rescue created more debt. Every crisis response pulled resources from the future into the present. The system worked as long as growth outpaced obligations. But growth slowed. Debt didn't. And the chain tightened. Breaking point. When the future pushes back, every system built on promises eventually faces a moment of reckoning. For some countries, it came suddenly. In the 1980s, developing nations borrowed heavily, encouraged by global banks. When interest rates rose, repayments exploded. Entire economies collapsed under obligations they could never meet. In other places, the breaking point was quieter. Japan entered decades of stagnation. Europe faced sovereign debt crises. Governments imposed austerity not because citizens demanded it, but because creditors required it. And then came the global financial crisis. Banks failed, markets froze. Governments stepped in. Here's the critical moment in the chain. Private risk became public debt. Losses were socialized. The bailouts were funded by borrowing. The future was charged for the mistakes of the present. Children who hadn't been born yet inherited the bill. Falut. Life inside the invisible chain after the breaking point. Life changes but slowly. Public services are cut. Retirement ages rise. Taxes shift toward consumption. Education and healthcare become more expensive. People feel pressure but don't see the source. It's the genius of the system. No single person is to blame. No single law created it. The chain isn't enforced by force but by necessity. Governments say, there is no alternative. Banks say, these are the markets. Citizens are told to adjust expectations. The future shrinks. Young people delay milestones. Families carry more debt. Risk-taking declines. Innovation slows. Yet the financial system remains stable because stability is purchased with obligation. Failed fixes. Why reforms never break the chain over the years? Leaders have promised solutions. Fiscal responsibility. Balanced budgets. Structural reforms. Modern monetary theory. Debt restructuring. But notice something important. Every fix assumes the chain must remain intact. Debt can be restructured, but not erased. Interest rates can be lowered, but obligations remain. Payments can be delayed, but never questioned. Why? Because the chain isn't a bug, it's a feature. Government debt is the foundation of modern finance. Banks hold it, pensions depend on it, markets price everything against it. Breaking the chain would mean rewriting the system itself. So reforms circle the problem without touching its core. Modern parallels. The pattern repeats at scale today. The numbers are staggering. Global government debt has reached levels once considered impossible. In many countries, debt exceeds annual economic output. Repayment relies on perpetual refinancing. This means one thing: the debt is never meant to be paid off. It's meant to be rolled forward generation after generation. At the same time, demographic shifts are tightening the chain further. Aging populations mean fewer workers supporting more obligations. Automation reshapes labor. Climate costs loom. And yet, borrowing continues. Why? Because stopping would reveal the truth. The system depends on future promises that may not be kept. Technology makes this even more efficient. Digital bonds, automated auctions, instant global capital flows. The chain is stronger and quieter than ever. The delayed answer: what is the invisible chain really about? So what is this invisible chain, really? It's not just debt. It's not just money. It's intergenerational control. It transfers decision-making power from the many to the few, from the present to the past. It limits what future societies can choose by binding them to yesterday's commitments. It ensures continuity not of prosperity, but of obligation. That's why it's invisible. Seeing it would force uncomfortable questions. 3 clear takeaways. First, government debt is not just an economic tool, it as a political force that shapes future choices long before they remade. Second, banks don't just finance governments. They anchor a system that depends on perpetual obligation and inherited responsibility. Third, every generation is told that debt is necessary, yet each inherits more of it than the last. A warning and an open question. We are approaching a moment where promises to the future exceed the future's ability to deliver. When too much is pulled forward, something snaps. The question isn't whether the chain will tighten. The question is, who will be holding it when it does? Call to action: if this story changed how you see government debt, share it. These conversations don't happen often because they challenge comfortable assumptions. Subscribe if you want deeper explorations into the systems shaping our lives behind the scenes, because the invisible chain only works when no one looks at it. Once enough people do, everything changes.